97% of the United States qualifies for this program. USDA Rural Housing is a 100% financing program that is guaranteed by the government. It has a 0% down payment requirement. It also will allow for the seller to pay up to 6% of the buyer's closing costs. So with USDA, they will allow for you to borrow up to 102% of the sales price. Now, what I mean by 102% of the sales price is, let's say you have a sales contract of $200,000. With the $200,000 is your sales contract, but you get the house appraised, and the house appraises for $210,000. What you can do is, if the appraisal comes in at $210,000, you can use that additional $10,000 to go towards your closing costs if you need it. Meaning your sales price will still be $200,000, but you can borrow up to $210,000, which is 102% of the sales price. So in some instances, if the property appraises for more, you could potentially get into the property with 0% down payment, and let's say in this case, $10,000 for closing costs. That is a potential opportunity for you to bring in no money to closing. This does not happen all the time, but USDA does have the ability to allow you to qualify for the 102% of the sales price. Another great thing about USDA is they allow for you to potentially walk away with money. In the instance of, hey, the property appraises for $200,000, sales price is $200,000. However, the seller has given you up to, let's say, 6%. If they've given you 6% in closing cost assistance to aid you with closing on the home, let's say there's money left over from the closing costs after all is said and done, USDA allows for you to be reimbursed for your appraisal as well as your earnest money deposit that you put down into the closing, which means you could essentially or potentially walk away with money after closing if all of the closing costs is paid for by the seller and there's some left over. So with that being said, USDA is a unique product. Not only does the borrower have to qualify for the USDA program, also the property has to be in the USDA eligible area. What you can do is Google USDA eligible properties, and when it comes up, go to Rural Development Guaranteed Program and click Accept. When you click on the Accept button, you can put in an address and it will immediately let you know whether that property is eligible for USDA financing or not. USDA is typically available in areas that have a population less than 35,000. That's why 97% of the land in the United States of America qualifies for USDA financing. When we think of financing in homes, we think of big metropolitan areas such as Atlanta, New York, Houston, Los Angeles, Miami. However, there's more pockets of land in the United States that is not considered metropolitan and that fits into this criteria. And the other great part is USDA is available in all 50 states. And I want you to also understand USDA is not a grant. It's a program that the government utilizes to allow moderate to low income families to purchase a home with low to no money into the deal at all, depending on if the seller pays some of the closing costs. When I say low to moderate income, that income basis is going to depend upon where you are at geographically. They look at household income, which is very, very important to listen to. Household incomes means anyone in the house who's earning an income over 18 years old, whether they are on the application for the mortgage or not. So they look at if it's a husband and wife duo and the wife is the only one on the loan, but the husband's in the house as well, they look at household income that comes in. Let's say even if your parents live with you and they receive retirement, however, they're not on the loan, if they're going to live in the house, that's still considered household income, and they're going to look at their income as well as yours. And the same thing if you have an 18, 19-year-old that's in the house working, they're going to look at that income as well as yours and your spouses and parents. Any adults income is going to be looked at for household income. I want to be very clear that you understand that USDA, while it's a great program and it's backed by the government, they do look at the totality of the household income, which at that point, even though the person on the loan may qualify, everyone else in the house's income may take them over the income limit, and it's also based on family size. So with USDA financing, you can purchase an existing home. You can also purchase a new construction home in a new construction development. And I want you to stay to the end about a special USDA new construction product that is available that not a lot of people speak on. Also with USDA, something you also want to understand, it is for primary residence only, meaning you cannot buy an investment property with USDA financing. You can also purchase a manufactured house, a condo, a stick-built house, a modular. You can purchase those type of houses with USDA financing. However, you cannot purchase a 2 to 4 family with USDA financing. It's specifically for single family homes. So with USDA, another key point is, and something that's very important is, it has a no seasoning requirement. What do I mean? So let's say you find a property that's USDA eligible that has recently been purchased by an investor, and the investor has only owned the home for 60 days. Well, if you looked at FHA, they have something called a 91-day flip rule where you couldn't do FHA financing on the property or even start the contract until that person has owned the home for 91 days. With USDA, if the person has owned the home for 60 days, they went in, renovated, and made repairs, you can purchase that home without having that seasoning period. Now, some very important things about USDA. USDA, while it's for low and moderate income families, it does have one of the lower caps on the debt to income ratio. They don't allow for you to exceed typically a 29% front end ratio, which is your housing ratio, which means over 29% of your income cannot be for housing, and 41% of your total income cannot be for your expenses, and housing included. So your current bills and your new mortgage payment can't exceed 41% unless you have a strong credit score and you can get something called an exemption waiver. Now, the other good part about it is that with USDA, they are very lenient on credit. You can go down to as low as a 550 credit score to qualify for USDA. There's typically not a credit score requirement. However, there is something called a manual underwrite, which means you cannot be approved with a desktop underwriting approval. However, they will go through and manually underwrite your file, and it has to stay within specific guidelines of USDA to get a manual underwrite, which allows for them to go to a lower credit score. I do want your preference in this conversation that the credit score, even though it's a 500 credit score, there are certain things that could appear on your credit score that would disqualify you for USDA, but you want to talk to a lender and allow for them to pull your credit and see if you can or cannot qualify for USDA. Another great part about USDA, there's only a 12-month requirement for you to live into the house. So you live in the house for 12 months, you've been able to save some money and move forward. You can use that property. You can either sell it if it has the equity, or you could rent it out and use that property as a rental and then go on to buy your additional property for your new residence. So a couple of things about USDA. So USDA also has something called a 1% funding fee. Their funding fee is their version of upfront mortgage insurance premium that you typically get charged with FHA, the funding fee that VA charges as well. So you want to, that gets calculated in. Most buyers finance that into the loan. So if you have a 1% funding fee and you get pre-approved for $200,000, your loan is $200,000, then your loan with the funding fee financed in is going to be $202,000. And the great part is USDA does not necessarily have something called mortgage insurance. It does have an annual funding fee that it charges, which is like 0.035% of the loan. So the annual funding fee, let's say your home is $202,000, which is your loan. Let's say the sales price is $200,000. We will add in the funding fee of 1%, which will then take your loan to $202,000, right? We take that $202,000 loan and we multiply that by 0.0035, which gives us $707 a year of funding for the funding fee. We take that $707 a year, which is the yearly fee, and we divide it by 12, which gives us a monthly funding fee of $58.92. So this is even lower than FHA or conventional mortgage insurance. So while there is a slight funding fee, this is used to help USDA guarantee your loan and have funds to back your loan if something were to happen and you were to lose your home. Now, at the beginning of the video, I told you to stay to the end for a special program. With USDA, you can actually do a one-time close construction to perm loan. What does that mean? Find a builder, build your dream home or a home on that lot, and have it financed 100% with no down payment from you. You do have to pay the closing costs, or you could potentially factor in the closing costs if your numbers work. There's a video about the USDA construction to perm loan right here, and the link will also be below in the descriptions. If you found this video helpful and would like to learn more, or you'd like to book a call, the link to contact me will be below. Thank you for listening. Have a great day.